My name is Min, and I will represent Group 10 for our start today. And our financial analysis will focus on a Mobile World Investment Corporation, also known as MWG. And our agenda consists of four parts, and we'll right here, and we'll move right into the introduction. So, for MWG, they started as a limited liability company, but changed into a joint stock company in 2007. And their three biggest contents are Thế Di Động, Điểm Mason, and Bát Hóa Sản, in which Thế Di Động is the biggest investment, and it accounted up to 55% of the total market share. Điểm Mason and Bát Hóa Sản also accounted for in a significant amount. Also, MWG has a lot of achievements, and I will pick out two of them biggest ones, which are the top 50 best big public companies in Asia, voted by Forbes, and also the best Vietnamese performing company. Really good. So the second part is balance sheet and income statement analysis. So first of all, the balance sheet. It has three parts, right? So first is the assets. In general, they are increasing, as you can see the numbers right here, but not really constant, as there are a big change in 2019, but a really smaller change in the following year. And the total current assets and non-current assets are moving towards an 80-20 ratio. As you can see here, current assets are shrinking down nearly to 80, and then non-current assets are moving up to nearly 20. Okay, so for current asset, there are a lot of change in 3 years, and the most significant we need to talk about is the short-term financial investment, up to 6,000%. And this may have be because of the company shows a more short-term strategy for this period, and that may have led to this big investment that may have led to decrease in other categories like cash and cash equivalents and other current assets. Okay, so for non-current assets, they are much less fluctuated. As you can see here, the margin between the growth is not really high, and they increase overall. So the most significant investment we will need to talk about is the fixed asset. It accounted for 70% in 2018, but moved more than 83%. So that's a really big number of the total non-current assets, and that the non-current assets also experience a decrease in other categories, mainly the long-term one. As we talked about before, MWG is moving nearer to a short-term strategy. Okay, so for liabilities, they also have a non-constant growth. As you can see here, the difference between the 2 years are really high. And we can see the dominance of current liabilities in the numbers that they are showing, representing right here. So for current liabilities, I would choose out account payable to suppliers and short-term borrowings to talk about, because they are the two biggest proportion in the total. So they all started, the total of these two categories started as more than 3/4 of the total current liability. But they are inversely related. The account payable to suppliers, they went down really bad, and short-term borrowings, they went up. Maybe this is maybe because the reconstruction that we just talked about before, the short-term strategy of MWG, and they may have chosen it because of external factors like COVID-19. They need to have a more safer strategy, and not rather than a long-term strategy, because we don't know what the COVID-19 disease can give out, what consequence. So MWG chose a more short-term strategy. So for non-current liabilities, there are nothing much to say. Long-term borrowings, they dominate the whole thing, and deferred tax, they were cleared in the 2019 and 20. So the overall, they totally went down, but they increased a little bit in 2020. Okay, so last but not least, total equity, they totally increased and accumulated up to 6.5 billion, increasing in 3 years. And in 2020, the total equity valued around 15.4 Vietnam dong. And the figures in this chart we need to talk about is the undistributed profit after tax and share capital. So for share capital, they went down a lot because maybe because the company decided to give out shares so that they can fund for their investment. And undistributed profit after tax, this can be procrastination because of the COVID-19. So they cannot distribute the profit yet. Okay, so the next part, we will talk about the comparison with competitor. Our team chose DigiWorld as their rival, and because this company is also quite impressive, it increased in total stock around 392 billion in the 3-year period. But as we can see in the two charts, MWG is still more dominant in in this field, and they have also shown why they are the top one retailer in Vietnam. And that is my part. Now moving on to the next one.
So we'll come to my part, which is about the income statement of Mobile World Group Corporation. The income statement for Mobile World Group respectively in the 3 years 2018, 2019, and 2020 provides the information of Mobile World Group business result with the useful information for the domestic and foreign investor as well as the readers. So about the income statement, here is the table of the income statement for Mobile World Group, and it's used to show the MWG's business performance year by year and will be compared to their direct competitors, which is DG World Corporation. Let's take a look at the total revenue. In 2018, the total sales and services revenue was recorded at 87,838 billion Vietnam dong. This could be considered as MWG success, as 2018 is the period of technology appliances. In the next year, Mobile World Group made a great effort to keep its performance by accomplishing 104 billion Vietnam dong of revenue, which is nearly 18% increase in the same period compared to the year before. However, with the appearance of the COVID-19 pandemic, the revenue for the year 2020 only marked at 109 billion Vietnam dong, which is only a 6.1% increase compared to 2019. The revenue of MWG mostly come from its two chain of retailing technology appliances, which are Điện Máy Xanh and Thế Giới Di Động in 2018 and 2019. But in 2020, apparently, there was a shoot up in Bát Hoa Xanh revenue by 10.5% in 2019 to 19.3% and account for the lost part of Thế Giới Di Động, while Điện Máy Xanh still took the lead. The cost of goods sold of MWG, as announced in the income statement, there is a slight increase in the cost of goods sold year after year. From 2018 to 2020, MWG's cost of goods sold reduced from about 81% to 77%. On the other hand, DG World saw only a little fluctuation in the cost of goods sold, as it's constantly marketed at between 93% and 94%. Compared to its competitors, DG World Corporation has a very high cost of goods sold and nearly record any deduction in the same period. This could be a minus point for DG World, as the cost of goods sold is nearly as high as the revenue, and it could reduce the profit that DG World can make. For the spend, a quick look at the spend of MWG in the income statement. There was not much fluctuation from 2018 to 2019, but from 2019 to 2020, there is a sudden rise from 40.6% to 7.65%, and most of it came from the business management expense, as MWG tended to open more stores in 2020. On the other hand, the total spend of DG World witnessed a constant figure, as its spend dropped from 4.46% in 2018 to only 4.44% in 2020, which shows a statisticity. This could be interpreted by the expense for financial expenses and administrative expenses remaining nearly unchanged, while selling expenses only increased a little bit in 2019. In general, it is apparent that MWG's total spend accounts for the larger part of the DG World's total spend. However, MWG still takes the lead in making profit in comparison to DG World by maintaining the cost of goods sold well. DG World need to make more effort on downsizing its cost of goods sold. About the EPS of the two companies, take a glance at MWG EPS. From 2018 to 2019, MWG experienced a satisfactory increase from 6,600 to 8,600 in a year, which is 22.8% higher year after year. But a year later, MWG EPS showed a disappointing result as it nearly remained unchanged. This could be explained by the poor business performance in the time of pandemic. In contrast, Digital showed entirely opposite aspect as its EPS increased remarkably from 2,700 in 2018 to 6,026 in 2020, which is 128.75% higher, a wonderful result for Digital by its performance. Moreover, Digital's EPS saw a consistent rate growth year by year and insane growth from 2019 to 2020. In general, MWG EPS is still higher than Digital in the period of 3 years. However, MWG needs to work more on its performance to increase their EPS to bring more profit to the company as well as their investor.
Hello, I am Jen from Group 10, and after having brief information about the balance sheet and income statement of the Mobile World Investment Corporation and the Digital World Corp, now we come to the ratios analysis. The first liquidity ratios is measure, the company ability to pay the, obligations and its margin of safety through the current ratio, with ratio, and operating cash flow ratio. We come to the current ratio. The current ratio of MWG slightly fluctuated from 1.3 in 2018 to 1.27 in 2020, and the current ratio illustrates how well the company managed its short-term assets, including cash, inventories, and receivables to pay up the short-term liabilities. And for 3 years, the current ratio always more than 1, which means that the net working capital was positive, and it showed that MWG was able to cover their short-term debt and had a low risk of bankruptcy. And we come to the WIC ratio. 2018, the WIC ratio of MWG was 0.33. After that figure dropped slightly in 2019 and experienced a slight increase to 0.61 in 2020, and the WIC ratio over 3 years was less than 1. It shows that the company may not attain a favorable financial situation. We come to the cash ratio. MWG experienced the fluctuated trend of cash ratio from 2018 to 2020, and the cash ratio is referred to with cash and cash equivalents, whether the enterprise makes sure timely payment of short-term debt or not. Therefore, the cash ratio of MWG of 3 years was less than 1, which indicates that the enterprise would have difficulties in debt repayment. We compare with the DGW. On the whole, current ratio from the DGW throughout 3 years was higher than MWG. However, both companies had good current ratios, since a good current ratio is greater than 1. Overall, in terms of quick ratio, both companies is zero negative value. And the last cash ratio of MWG from 2018 to 2020 was nearly similar with that of competitor. And we come to the efficiency ratio. It's known as the measuring a company ability to use its assets to generate income. And Mobile World Group witnessed a gradual downward trend in total asset turnover ratio between 2018 and 2020. Total asset turnover indicates, the efficiency with which a company uses its asset to produce sales. For 3 years, the ratio is always greater than 1, which means that MWG used its asset efficiently and was successful in increasing the company profitability. In 2018, the inventory turnover of MWG was 4.08. After that, the figure decreased slightly to 3.16 in 2019 and reached a bit in 2020. Inventory turnover demonstrates, how successfully a company manages its inventories. The greater this ratio, the more efficiency corporate handle their inventories. So, in 2020, the MWG managed inventories the most efficiently. And we come to the receivable turnover. The MWG's receivable turnover ratio climbed dramatically and then skyrocket in 2020. Receivable turnover demonstrate the company's capacity to handle liabilities, receivable, and recover cash on those liabilities. And MWG, has performed well in debt collection. We compare with the D3W. Overall asset turnover of MWG, was lower than the D3W in 2019 and 2020, which means that in this case the D3W was more efficient than in selling its assets, while MWG experienced a downward trend in inventory turnover in 3 years. The inventory turnover of D3W witnessed a significant upward trend, and it illustrates that the D3W managed inventories much more efficiently than MWG did. However, between 2018 and 2020, the MWG performed better in collecting debt. And this is the end of my part. Next, Cole will continue.
Thank you, John, for your part. Now, hi everyone, my name is Minh Khôi, and now we will take a look at the long-term solvency and profitability ratios of MWG. So first, we will come to long-term solvency, which is the magnitude of company profitability to its commitment. Long-term solvency including total debt ratio, time interest earned ratio, and cash coverage ratio. With total debt ratio or debt to assets ratio calculated by dividing total liability to total assets, it is used to show how well the company pay off its debt. And if the ratio of the company is less than 1, it means that the company has more assets than debt. And in contrast, if the ratio of the company is greater than 1, this means that the company is having more debt. From the chart, it's clear to see that MWG total debt ratio is remaining stable after 3 years, and they managed to keep it lower than 1 or at around 0.7 from 2018 to 2020. So we come to the conclusion that MWG is really stable in terms of controlling debts and access. Next is the interest earned ratio, followed by the formula EBIT divided to the interest expense. This type of ratio is used to predict how well the company can deal with its interest payment. And a larger number shows better ability if the company has to cover its interest by its earnings before tax. And MWG is not having a large number of time interest earned ratio, just at around 8.7, but the company is stable, keeping the ratio stable, and it's soon to conclude that MWG is still having control in paying its interest. And take information from the total debt ratio, it's clear to see that MWG having no trouble in taking over debt. And the last ratio of long-term solvency is the cash coverage ratio, quite similar with time interest earned ratio, measuring how well the company pays interest by company available amount of cash. MWG has quite equal number of 2018 to 2019 at around 11.4 and slightly increased about 1 point in 2020, which means that the company already doing well with paying interest in cash, and in 2020 the company having a lot more investment cash than the previous year, leading to an increase in cash coverage ratio. Now we will take a quick look at it compares the DGW. In comparison, MWG and DGW have been quite similar total debt ratio at about 0.6, and both companies are doing well, keeping more assets than debt. But with time interest earned ratio, where MWG outperformed DGW in 2018-2019, but DGW having a huge improvement by increase about 60%, even better than MWG in 2020. It is clear to see that MWG was better in 2018-2019, but DGW have less than behind in 2020 at this ratio. And the cash coverage ratio is quite similar with time interest earned ratio, where MWG outperformed DGW in all 3 years. And DGW having a huge leap in this ratio and increased almost 60% in 2020. In conclusion, MWG was doing better, but DGW having a huge improvement in 2020. So now we're moving on with profitability ratio, which a class of financial metrics that's used to assess the business ability to generate earnings related to its revenue, operating costs, balance sheet assets, or stakeholder liquidity over time, using data from a specific point in time, including net profit margin, return on assets, ROA, return on equity, ROE. The net profit margin, or simply net margin, measuring how much net income or profit is generated as a percentage of revenue. Net profit ratio is the most important indicator of our company financial health. MWG has a low net profit margin, which ratio is still be equal after year at about 0.035. Despite having a low ratio, MWG is still making a large profit every year, over 23,000 billion VND in 2020. So now we move on with return on assets and return on equity. Return on equity and return on assets are two of the most essential metrics of assessing how well a company management team manage the capital interest to it. Despite the two different ratios, their formula are quite similar. While return on equity is calculated by dividing net income to shareholder equity, return on assets formula is net income over total assets. It is clear to confirm that MWG is borrowing capital funds to expand business by seeing that MWG's return on equity ratio is significantly larger than its return on assets. The company return on equity is slightly down, but MWG is still doing a really good job when managing the ratio, remaining at around 28.4. And with the return on assets of MWG having decreased by about 2% in 2020. Comparing with the WG, MWG was doing better than DGW, about more than 0.02. Still, with some cases above, MWG was having a better return on equity than DGW, but DGW outperformed MWG in terms of improvement. And with return on assets, MWG is doing better than DGW in 2018 and 2019. In 2020, the DGW has left MWG behind with about around 0.01. The next part. So that's the end of my part.
So we are back to my part, which is about the market value ratio, which will be analyzed the two ratio, which is PE ratio and PP ratio. First is the PE ratio. According to the figure in the slide, from 2018 to 2019, the PE ratio of MWG witnessed an increase from 10.04 to 13.16. This means that the investors were believing in the growth potential of MWG stock price. However, in the following years, this ratio seems to decelerate and only increase for a tiny amount from 13.16 to 13.74. This could be explained due to the EPS of the stock. The EPS of the 2 years 2019 and 2020 witnessed more or less no change. However, there was a slight increase from the stock price, which made the PE ratio become higher. In contrast, DigiWorld experienced the entire increase from 2018 to 2020, from the ratio of 18.879 to 26.694 within the 3 years. DigiWorld's EPS also raised at the same pace, but the PE ratio still increased. Thus, the price per DigiWorld shares might have been believed to have a magnificent increase. About the price-to-book ratio, it is apparent in the chart that MWG's PP ratio witnessed a downtrend from 4.17 to 3.48. This means that although the company operated well and constant, the growth rate of the company cannot adapt to the investor expectation. Contrastingly, the DigiWorld's PP ratio experienced the ascension through the same period. It increased from 4.01 to 7.2. This shows that the investors are willing to pay a high price for a DigiWorld share because the corporation may have had the potential to grow and the investor believe in that. In general, although the market cap of MWG is much greater than DigiWorld, DigiWorld shows itself as a company that the investor should invest in because it will bring more profit to them in the future by stable performance. And now we'll come to the conclusion part, which is presented by John.
Hello, I am John again, and now we come to conclusion. In sum, the Mobile World Investment Corporation, is currently making good use of and managing its assets. Furthermore, the revenue, generated from shareholders' equity was found to be profitable during the research period. However, there are several drawbacks to consider, including the fact that the return on equity ratio indicated suggests that misuse, and which could both benefit and put the company at risk in the long run. So some recommendations would be that the MWG could open more service and increase customer experiences. Moreover, they can open more stores in their potential chain to increase more the revenue and profit. In addition, the MWG can find the best suppliers in order to reduce the cost of goods sold to increase the BAT and make the financial ratios better. And that is the end of our presentation. Thanks for listening.